Welcome to the What to Watch video update. This is the last video that I do over the weekend where I go through all the charts, daily and some weekly charts, and I pick out those charts that really seem to be saying something right now, and I categorize them into positive, negative, and then just things that we're keeping an eye on to see if they have an impact on the overall market. This week we're asking the question, has the S&P 500 bottomed? We had a pretty good week and we're at the top end of a trading range. We're getting a little bit overextended to the upside in the short term. We are positive in the short term, but we're still negative in the intermediate and long term. So we'll go through and look at some charts and see what we can come up with here. First, we look at the positive side. Since we had an up week and it was a pretty strong week, I put this intraday chart here on the positive side. It was looking pretty bad back on Monday. We went all the way down and touched 5,100. Well, we closed up above 5,500, so that's a 400 point swing from the low on Monday to pretty much at the highs where we closed on Friday. That's a pretty good move, but it did not start out looking very good. But we did see a little bit of late day buying going into the close, and it's the professionals who closed the market. Now, I picked up on this at the time, but I thought, just a little bit of bouncing up here. Well, we were able to carry that through into Tuesday. The futures were positive. That produced a gap higher open. We went back up and we started to come back down during the day. But then again, we saw some fairly good late day action here. We fell off, but then some buying going right into the close. Now, Wednesday was what looked like was going to be the breakout day when we were really going to turn positive. We had a massive gap higher and we hit this R3 level here, and then we spent the rest of the day going down. Now, to me, when I did the daily video, I was saying this was really more of a negative day than a positive day. We were up, but only because of the gap. If you look at the price action, we trailed off. We set the high early, we closed just a little bit off the low. So that's really not showing an awful lot of strength. Then Thursday happened, and that's where things look more sustainable here. We didn't have much of a gap, but then we saw just some buying coming up. We hit some overhead resistance. We kept going up and we finished pretty much at the high. This is more orderly. This isn't all spastic, not all emotionally driven. This was really some strength. And we had some indicators that flipped over, long-term indicators and some important indicators that have actually switched over to positive, and that happened after Thursday's session. And then instead of falling on Friday, we had a choppy open, but we went all the way up to this R1 resistance level, fell back, and then closed again at the high. So it ended up being positive. But again, Wednesday was probably the day when everyone thought everything changed. Personally, I think it was Thursday because Wednesday was actually more negative. But then we saw some strength coming in that then carried through into Friday. Now the question is, can we see more momentum going forward from here that's turning back positive? Because we still have a lot of technical damage that's been done to the charts. So can we see some more recovery? All right, let's go through and look at some other things. For almost all of April, when we look at sentiment, we've been below 25. Well, now we're starting to go back up. We came back down just a little bit on Friday, but the fact that we're going up is more positive. And as I say, every time I see this chart, we usually come down, everybody freaks out, we drop below 25, we V bounce out of that, and that usually marks a low in the market. And we can see that other times recently where that's happened. Well, we went down below 25 in late March and just stayed down here for pretty much all of April. And that's extreme negative. So instead of having a V bounce, this became like an oasis of negativity here. Well, finally, we're starting to get back up here. Now, we're still negative. We're just barely above 25, but we are improving. And the context of this is that we're going up. If sentiment can improve, eventually get above 50, that would show that things are even looking even more positive on a sentiment front. We're seeing a slight improvement here. Over the last number of trading sessions, when we look at the intraday chart of growth to value, they've been more neck and neck with each other, keep going down together, going up together. It's like they're double dating here. Well, we're finally seeing a little bit of a breakout with the blue above the red. That means growth is outperforming value. That's when the market is really strong. You go back here to February, we set the high right around here and see what happened to growth after that. See what happened to value. No, they both went down. But when this drops below, that means the growth is underperforming value, even though these are two different indexes on different scales. We can still get a visual perspective on what's leading to the upside or downside. So we want to see this blue line continue to go up if we're going to stay more positive. And we were showing signs of improvement earlier in April, but then that fell off here. We actually started to come down when we look at the intraday chart of growth to value for the S&P. This is the one that I probably focus on the most. Well, we've started to bounce back up, and this is showing that growth is outperforming value intraday. And that's what we want in a more positive environment. We're seeing some improvements here with our growth to value ratios. Now, these are end of day charts, and we look at the Qs to SPY because the Qs are growth, the SPY is growth and value, and we're coming up above the moving average. Discretionary to the S&P, that's coming up above the moving average, and large cap growth is now outperforming large cap value. Now, these moving averages are leveling out at best. We need to stay above these moving averages and see everything continue to go up for it to be more positive. When we were really coming down, you can see how the moving averages were going down as these ratios were also going down. We look at the large caps, and that's what we focus on the most here. We're coming above the moving average here. It'd be nice if the moving average started to go up, but we're also seeing some improvement with the growth to value ratios with the mid caps and the small caps. We're improving with the short-term trend. We're actually positive. Now, my definition of positive is when we're in the short term anyway, when we're above the 20 period simple and exponential moving averages, and we are. Well, this is another type of study. It's a double and triple exponential moving average study. These lines move really fast. And so I use this more to tell us what's the condition of the short-term trend. When we're below and the lines are coming down, the short-term trend is vulnerable or negative. Well, we're starting to turn back up. We're above both the lines, and the lines are starting to go back up as well. So we are looking better in the short term. And if the intermediate and long term are going to turn positive, we need the short term to turn positive first. So this is encouraging. Then we look at the advanced decline line. Now, a week ago, we were mixed with this chart because we had dropped below the moving average based on volume for the advanced decline line for the S&P. We never did drop below the moving average based on price. Now, price is the ultimate indicator. We don't buy things because they have high or low volume. We buy because they have high or low prices. Well, we can use volume to tell us what's the in how much power, how much velocity is behind price movement, because if there's a lot of volume behind it, that usually shows there's more conviction. Well, we were able to come back above the moving average here based on volume. So now both of these charts are positive and advancing. We ticked down just a little bit on Friday. And then we look at the advanced decliners. This is based on price over a 10-day period of time. And then this creates an oscillator where we look for extreme positive or negative readings. When we're above zero and advancing, that's positive. Well, we're getting close to this 100 level. We're a little bit above that right now. Now, we could still go up from here, but this is showing good short-term momentum. But we want to be careful because we might get to kind of an extreme reading if we continue to go up with a lot of velocity. Then we're also improving with the short-term advanced decline ratio. Now, there's another chart that I show of this that has a red line and a blue line. This is a chart that I show because it shows price and volume. So the red line and the blue line, that's short and intermediate term. This is short term with its 19-day. And we're above zero and going up based on price, and we're above zero and advancing based on volume. So that's also showing the short-term trend is more positive for the S&P. Now, this is positive, but negative at the same time. We're going up with the 5-period moving average and the 10-period moving average. That's why this is positive. But if you look at this, it's not that we're seeing a lot of new highs. It's that we're seeing a contraction of the new lows. And that's what's causing these moving averages to go up. Now, that's the negative side. So it's how you want to personally interpret this. If we continue to go up here, I would watch the new highs and new lows, and I show these in every daily video that I do. And if we see the green continue to expand, that's going to really help things a lot. That's more internally showing that we're seeing some strength. But if we continue to just kind of chop along sideways here, and maybe we're still going up with the S&P, then we're not really seeing any strength at that point. Then we look at three smart money indicators. The first one here is accumulation distribution. And there's a couple of ways to interpret this. If you're more conservative or if you're a little more not conservative or aggressive. The conservative way is to say that this is positive when we're above the red line. Okay. And we're above that. So that would be positive. The more aggressive way would be to look at the boom indicator down below, which has kind of developed into something different than the reason why I actually put this on the chart. It was supposed to measure how far we are above or below the red line, but it really doesn't do that all that much. We get all crazy here. But this is a modified MACD, which is a momentum oscillator, and it's short term. And we can use this to say, okay, when we're below the moving average and going down, that's negative. When we're above the moving average and going up, that's positive. And that's what we're seeing now. So you could use this to confirm things that we're positive since we're above the red line, and we're also positive because we're above an advancing moving average with the boom indicator. Smart money indicator number two is positive. The Chaikin money flow. We're green. We're going up. The red line, which is a little hard to see here, it's going up as well. So that's 2 for 2 with our smart money indicators. And our third smart money indicator, the Chaikin oscillator, it's above the midpoint and going up. So 3 out of 3, we're positive that way. We're positive on the daily chart with the parabolic SAR. Now we're still negative on the weekly side, and I'll show the weekly chart when we get over to the negative side. But at least on the daily chart, we are still positive here. And we just saw after Thursday, the vortex. It was picking up that strength that we saw in Thursday's session, and it actually saw the green line cross above the red line. So this is now switched back to positive. And we're showing good momentum here, even though we dropped down a little bit on Friday, although it was an up day. There was probably some internal selling going on there. But the S&P McClellan oscillator is above zero and going up. We're not necessarily extreme right now. If we do continue to go up and get above the 60 level, it doesn't mean we'll stop there. But usually this is when we start to pay more attention to it to say, okay, maybe it's maxing out in the short term. Now, when the McClellan oscillator is above zero, the next chart, the summation index, that's when we're going up based on price. And then a completely different indicator that I also plot on here. This is the summation index based on volume. And when both of these are going up, that's positive. And that's what we're seeing right now. Then to get a broader market perspective, the NYSE McClellan oscillator, we're coming down. We're just a little bit above this 80 level here, but this is showing more broad market strength that we've been seeing. And when this is above zero, we're going up with the summation index based on price and volume. This isn't a separate indicator. This is just one of the standard ones that I put on this same chart. Then the swollen trading oscillator, even though we're rolling over a little bit based on price, we're going up and we're above the midpoint with price and volume. That's positive. And the momentum, because we've just been getting jacked around like crazy, going up, down, all around. It's like a roller coaster here. But finally, the momentum oscillators are giving us a consensus right now with the short, intermediate, and long term, where everything is now in an uptrend. And here's another momentum oscillator, the Copic curve. It's also positive. It's above the red line. And this is where we were seeing strength earlier in the week. Even when we were having a bit of a difficult time on Wednesday, the bullish percent index just shot up like crazy. And that shows that there was internal buying inside of the S&P. Well, this is above 50 and going up, and it's above its moving average. This is another primary indicator. And this measures the point and figure buy or sell signals. When we were going down, that means there's a lot of point and figure sell signals. We hit an extreme negative reading. We've been bouncing up. Now, I put a moving average on here that's a little hard to see, but when we get above the moving average, that turns this indicator positive. It's a confirmation of being positive when we also cross above 50, and we're above that, and we're continuing to go up. And we still have some more room to run before we get to the 70 level, which this is when we think, okay, we better watch this a little closer. It might be getting exhausted. And we're above 50 with the stocks inside the S&P above their 20-period moving averages. We ticked down a little bit on Friday, but And the other ones, the 50 period moving average study, the 100, the 200, they're still well below 50. But short term, this is actually turning positive. And I usually don't show this. I know the RSI is a really popular indicator. I learned MACD and RSI. Those were my very first two indicators to learn way back in the early 90s. You use the MACD for momentum, and then you use RSI for overbought, oversold, and also as a momentum oscillator. Well, we've spent a lot of 2025, especially March and into April, below 50. And this is an RSI 14. It's more intermediate term. Then there's an RSI 9. This is more short term, and this has been negative as well. Well, both of them are starting to cross back above 50, and the short term moves a little bit quicker, so it's showing a little bit more strength. So this is a positive improvement with momentum. Can we stay up here? Can we build a period of time where we're above 50 with both of these? That would really help things a lot. And this is long term. This was developed by David Keller, who works with stockcharts.com. He also has Market Misbehaviors, a website and service that he operates. He really likes the PPO. This is a weekly chart of the S&P, so it's longer term. And then there's some moving averages that are plotted on here, a 5-week, 13-week, and 21-week. Why those particular moving averages? I use different ones, but that's okay. I don't look at the moving averages so much. Then we look at a long-term version of the PPO, which is a momentum oscillator. And we've been coming down, but we haven't quite turned negative yet. Intermediate term, we've been coming down and we actually turned negative, and now we're showing a little bit of a bounce up here. And then the bottom here is the short term, where we have been improving and we're actually turning back positive in the short term. But all of these are based on a weekly chart. So short term, that's a short term weekly version of this indicator versus intermediate weekly and long term weekly. Then this is why we're positive in the short term. This is the simple and exponential moving average. I get asked all the time, which one's better? How are they different from each other? A 20 period simple moving average takes all 20 periods, adds them all up, and divides by 20 to get the average price for that day. Then the next day, the 21st day is added and day number one falls off. Everything is treated the same. Where an exponential moving average, it weights the how it's calculated more to current prices. So like day 17, 18, 19, and 20, they would get more weight in the calculation than day 1, 2, and 3. And some people think those are a little bit better. I get asked all the time, which one is better? Both. Okay, they both have their purpose, and I plot both of them on here. Studies have shown that simple moving averages are generally better because they're slower, and if you have a tendency to be slower in the market in the longer term, you tend to be more positive. Where an exponential, you're like getting a signal and freaking out, buying or selling or doing whatever you're doing. Where if you just waited, things would have worked out a little bit better. So I plot both of them on here, and even this is a little bit helpful because the blue line moves quicker than the red line. When we're going down, that just means the short-term trend is going down a lot faster. Then we saw a little bit of a bounce here. Then we were going down. Now we're starting to turn back up, and we're seeing the exponential, which moves quicker, actually going above the red line. So it's turning up, and the red line's still going down, but could start to turn up. How I say this is positive is that we're above both of these moving averages right now. And so the short-term trend, according to this, is now positive. But we're probably getting a little too far away from the 20 period moving average. Now, when we were really screaming down here, we were getting far away from the moving average to the downside. Well, not only have we come back, but we're starting to get far away from the 20 period moving average to the upside. This is how we use this like an oscillator. And the boom indicator here, it measures, okay, how far away are we from the moving average? Because price has a tendency, once it gets too far away, it's like a dog leash or a magnet, or you have a tendency to come back to the moving average. And we got really far away from it to the downside. Now we're starting to get far away from it on the upside here. And so that's what this indicator is picking up. We're still below zero here when we measure the distance away from the 50 period moving average, because we're still below the 50 period moving average, and we're still below the 200 period moving average. So that's why this is negative. The reason why I'm showing this here on the positive side is we've seen a nice little bounce here. On the negative side, maybe we're going up a little too fast right now. Then the point and figure charts. Anytime we have an X, that means there's more buying than selling. Now, this doesn't take time into account. It's just price. And we were like in this box here for quite a while. Actually, this looks like a big P here where we came down, came back up, and we've been boxing sideways here. We're finally starting to break out here on the point and figure daily chart. And that's once we broke out, that's a triple top breakout because we came up here three times and now three times a lady right here. So it's actually starting to show some improvement with this. And we're also seeing an improvement with the weekly chart where we came all the way down. These are the O's as we were diving lower. Well, we've been coming back up, drawing X's, and we saw another one here that was generated after last week. This is a weekly chart, and this is a low pole reversal where we were going low with the pole. Now we're climbing back up the pole here. So it's picking up some positive price action. Now, long-term support that held right near the beginning of April when everything was just going in the toilet. We came right down to this 50% retracement level and just bounced up off of that. We barely spent any time there, which is good because this is a major support level measuring from the October 2022 low to the February 2025 high. Now, we lost the 38.2% retracement level, but the 50% level held, and we've since been able to regain that 38.2% retracement level. And we're back above this long-term weekly chart of the S&P going back to the 1987 crash. We dropped below the trend line. Well, now we're back above the trend line. And this is that same chart just showing the last few years to make it a little easier to see that we're above the trend line again. These are pivot points that we know about even before we get there based on time. These actually are good for the whole quarter here. And we're above this S1 level. Now we broke down below that and we were able to get that back, but we're still above this S1 level. That's the positive side. Now, the frustrating part is we're still below this pivot point here. That's at about 55.75. If we can get up there and close above it, now this is a weekly chart, so it won't really count until Friday. But if we can get above that 55.75 level, close above that, that would turn this chart even more positive. And then now, my personal opinion is lines that are horizontal have more power than lines that go up or down. You may disagree with that. Trend lines to me, because and there's so much subjectivity. You could, I showed a chart of this same thing in one of the daily videos, but this whole channel was drawn completely different and came to a completely different conclusion. Well, I'm trying to follow the strict rules of technical analysis here, where you're connecting the lows, and that's what I did. And then I drew a parallel line here, which is connecting mainly these highs that we set back in 2014. We got above them in 2021 and then fell back below it. This was the right before we went into the bear market of 2022. Well, we were coming down and we were hitting this midpoint here, and that held, and that's positive. And so far, we're still above this particular midpoint. This is another long-term trend line from the October 2022 low to the October 2023 low, and then just extending that trend line forward. And we saw a whole convergence of the midpoint of the previous chart, the 50% Fibonacci retracement level, and this chart all came together at the same point. And people that say technical analysis doesn't work, it's just because they don't know what they're doing. But all of that, because there's math around this, and all of this came together in a convergence, and we've been able to bounce up off of that. And this is long-term support that continues to hold. And this is very long-term here, a monthly chart and then a 50-month moving average. This blue line here, it's still going up. That means the long-term trend is still positive, and we're above the blue line, even though we came down close to it. So far, this has been holding up. Another thing that's improving, because it was looking pretty bad there. Staples, which are toilet paper and toothpaste, defensive things. This is what the market gets into when they're getting ready. They think it's going to go down. When this ratio is going up, that means staples are outperforming the S&P. Well, over the last few trading sessions, this ratio has really dropped. Now, if it can continue to go down, and other times when it spikes and goes down, that often and does really good things for the S&P. Unfortunately, we've had a couple of spikes along the way here, only to get faked out and then go up even higher with this ratio. So we're not, one of the drawbacks to this chart is we don't really know without using hindsight to know if this was a legitimate spike or not. But for the time being, the fact that this ratio is going down, that's improving. And we are improving when it comes to the S&P with the advanced decline line. Now, the moving averages that I showed earlier, those are different. This is a 50 period moving average here, but the S&P is above the moving average, and the moving average has pretty much stayed flat. Now the NYSE common stock, it's above the moving average, but you can see we were seeing more weakness there. And so the blue line was actually starting to come down where it was flat with the S&P. We were also declining and we're above the moving average with the mid caps. We're still below a declining moving average with the small caps. But the reason this is positive is because of the S&P 500 being above the moving average. Then it's looking better here with the weekly chart of the NASDAQ 100. Not in the purest sense here, but you could make a case for this where we came down, we set the low, and then we set a higher high here. We didn't set a lower high. I mean, we did, but then we set a lower high here or a lower low. Okay, let me take that back. A higher low. But if you look at these two up candles here, we are setting a series of higher highs and higher lows. That's what I meant to say to begin with here. And this is showing an improvement right now. And right here, we have this anchored moving average. We never did even come down to that. That's very long term. And we didn't get close to that with the NASDAQ 100. The staples to tech ratio, this is similar to the staples to S&P ratio, but tech is growth. And so we had been seeing staples. In fact, they're still in an uptrend when compared to tech with this ratio, but this has been coming down. If this can continue to fall, that'll be more positive. And we look at another ratio of the QQQs, the NASDAQ 100 to the small caps. Small caps are really under a lot of pressure. The Qs have been improving, and so we're seeing this ratio continuing to go up. If you're wondering what this is, this was the dot-com bust back in 2000 into 2001. And we're looking a lot better than that right now. This is another ratio between growth versus value. The NASDAQ 100 is pure growth, where the Dow is considered to be the best of the best stocks, but there's like Nvidia and Microsoft, which are growth stocks in there. But this ratio is actually holding up. This was another part where we topped out in the year 2000 and then had the dot-com bust. We're above this red line here, so this is holding up fairly well. The financial sector, it got hit with everything else. It was underneath its 200-day moving average, and we're back above the 200-day moving average, which you could say is negative because we're below the 50-period moving average. But this trend is holding up a little bit better. Where we've gone to downtrends on other indexes, the uptrend here, the blue line's still further above the red line. Now it's going to be even more positive if we can get above the 50-period moving average and see this trend start to go back up. It was a matter of debate until I looked into it a little bit more, and really it's pretty cut and dry. Marty Zwag was somebody who he's since passed away. It was one of the very first books that I read way back in the late 80s, early 90s, when I first started investigating the markets for myself. He created this thing based on his research. It's called the Zwag NYC Breadth Thrust. There are people on Twitter or X saying it's not legitimate. It is legitimate. It was only short covering. We didn't get in there within the 10 days. Okay, based on what I can tell right here, we were really going down and we set a low below this point 4 level right around April 10th or 11th. And then we started to bounce back up. And then once we cross above this point 4 level, we have 10 days to get up to this 0.615 level. That's the red line. Well, we got up there on Thursday. That was one of the longer term signals that was triggered. The track record for this is pretty good. I mean, you go back to some others, WAG NYSE Breath Thrust. This was a little bit late here that we saw about a year ago. But still, even when it's a little bit late, look at what the S&P did after that. So you can see this is pretty good. Now it's not automatic. It doesn't mean we're shooting to the moon from here, but this helps support the case that maybe we're looking more positive than we are negative. And we're improving a little bit with the semiconductors to tech ratio. We want this ratio to be going up like we were at the beginning of 2024. That was really why the market was screaming higher. We topped out over the summer, and then even though the S&P was still going up, this ratio was coming down. And then it really started to get under pressure once we got into 2025. Well, it's improving a little bit here, but we need to see more than this. We need to see a trend of this ratio really going up. Now, tech can go up too, and tech probably will. When this goes up, that just means semis are outperforming tech, but they both can be doing well at the same time. And we're seeing an improvement here. When we look at high beta stocks, these are stocks when we're going up, like Apple, Google, Nvidia, Microsoft. They outperform the indexes when we're going up. Unfortunately, they also outperform on the way down, which means they go down faster than the indexes do. And so when the market's really going down, we see this ratio coming down when we do a ratio of low beta stocks. These are the boring toilet paper, toothpaste type stocks. But that's what folks get into when the market is getting more defensive. Well, we've seen this ratio improving lately. We need to see more follow through for this to stay positive. And I update this in every daily video. This is long term for the SOX index. These are semiconductors. This is a 200-week moving average. This is like longest of the long-term trends. You notice how the blue line's still going up. So the long-term trend is still positive. We came down, we challenged this area, and we are above it. And so that's positive for the semiconductors. Now we look at some of the negative things. Now, on a trending basis, because moving averages move slower than some of the other indicators that we have, we're negative here because the 50 period moving average is below the 200. And we haven't even come back up to either one of those moving averages yet. We're negative, and out of all the different indicators that I go through in the program that I have, this is still the negative one. It's the ADX. It's what I use to determine the condition of the trend. This is the short term. I mainly focus on the intermediate term, but the black line is the ADX. And when the ADX is going up, that means the trend is getting stronger. It's not telling us direction, it's telling us strength of the trend. Well, the ADX has been coming down, and I put the moving average on here to give it a little bit of context to tell a little bit easier, are we going up or down? That means it's a weakening trend. It doesn't mean the trend's gone away. It just means that this downtrend that we've been in is showing signs of weakness, which quite often happens before we see a trend change. Well, then we get the positive and negative by looking at the red line and the green line. The red line's still above the green line, so we're negative. Even though the red line's coming down and the green line's trying to go up, they haven't crossed yet. This will not officially go over to positive until the green line goes above the red line, if that even happens. This is the one that I look at the most. This is intermediate term. We're also seeing a weakening of the ADX, and the red line is above the green line. Then every week, I like to show this too. This is a weekly chart of the long-term trend. This is still negative, and we're still showing a strengthening trend here. We're above 20. That's a static level that determines whether we're trending or not. We're showing a strengthening trend because we're going up above the moving average, and we're negative because the red line's above the green line. Now, the red line's coming down, but it's going to have to go down a long way, and the green line's going to have to come up a long way for these two actually to cross over positive. And even though we're coming down with the VIX, we were up over 40, then over 30. Now we're dropping below 25. That's good. We like that the VIX is coming down, but we're still freaked out because it's still above 20. So until we can get back down into 20, and I read something that says anytime the VIX is over 20, that means the bears are in control, sellers are in control. If we can get back down to 17 or below, that's when buyers are in control. And I'm going to watch that. I'm going to, it was, because I've been trying to do some additional research on the VIX other than is it going up or down. So this is improving, but still negative overall. And this is borne out by some research that Tom Bally did. He's also connected to stockcharts.com, and he has another site called earningsbeats.com. You might find that useful. But whenever the VIX is above 20, that's why this whole area appears red, because we're above 20 now. That's when the annualized returns are negative. They only turn positive when we start to drop to 20 or below. And the more we go below 20, the higher these annualized returns become. So that's another reason for just being a little gun shy right now with the VIX still above 20. And then for the ninth week in a row now, individual investors remain extreme negative. Now, this is about a week old, and we've been showing some improvement. So these guys are probably not going to be extreme negative a week from now. I don't know, unless they're totally impossible to convince. But this is probably going to improve. But to see this down here for 9 weeks is very strange. Usually we V bounce out of this because these are individual investors. They're usually not doing this full time. They may not have as much experience. And I'm in this group. And anybody watching this video, you're in this group too. And so sometimes we have a tendency to act too much by our emotions instead of using logic. And so we freak out because everybody else is freaking out. Well, we all freak out together. We get that over with, and then we end up bottoming and then bouncing up from there. Well, we've just camped down here at I'm not going to buy anything territory for 9 weeks. Now, we're not really good here, but we're not really terrible. We are seeing an improvement with the small cap growth of value, and we want this to go up to be more positive. And look at this poor index just going in the toilet. Even though we are bouncing back up here, it's got a lot of damage to repair. So we are seeing some improvement, and it's just barely hanging on to an uptrend. And we're barely hanging on to an uptrend here with the mid cap growth to value ratios. The reason why this is negative, I like to keep those three charts together. We're in a downtrend when we look at S&P growth to value. And we're below the moving averages. We have been. We're starting to come back above the 50. If we can get above the 200, eventually turn this ratio around, that would really help. When growth outperforms value, the market goes up. When value is outperforming growth, the market goes down. And we've been seeing this ratio really going down as the market's been going down. If this ratio can go back up, then the market has a better chance of going up as well. This is another look at growth versus value. We are improving, but we're just coming up to the underside of this rainbow. Another way we look at growth versus value is discretionary versus staples. Discretionary would include things that make life fun, or big names that you probably heard of would be Tesla and Amazon. They're considered discretionary stocks. Well, you can look at the discretionary sector, and we'll be looking at that here in just a second. Well, this is an equal weight, kind of like the S&P 500 equal weight, because Amazon and Tesla, they're huge stocks, and so they might have more of an impact on the discretionary sector. Well, this treats everyone a little bit more equal that's in that sector. We've just seen a recent death cross here with the sector itself, where staples have been holding up a little bit better, even though they're still in a downtrend here. The blue line's below the red line. And we're starting to see a death cross here with the ratio between the two, but this is bouncing back up. Going back to last summer, this was the best performing sector. This discretionary was doing well, and the discretionary to staples ratio was doing really well. To turn back positive, we're going to need to see this ratio turn back and show some improvement here. Now, this breaks it out, and these are relatively new charts, at least to the videos that I do, where this is just discretionary, the weighted discretionary versus the weighted version of staples. Where if you look at this overall, we have been declining, but we're improving. And you're going to see a lot of that through all these charts here. The equal weight, negative, but improving. The tech, that's growth. Utilities, that's considered value because you have to have electricity, you have to have utilities, no matter what's happening in the economy. This has been going down, meaning utilities are outperforming tech, but improving. Biotech, that's the growth area of healthcare, and then doing a ratio with the healthcare sector, declining, but improving. And then hotels, you could be, hey, if you're doing pretty good, you might go stay in a hotel. If not, you're camping in the woods. So you can choose to be in a hotel or not be in a hotel where you have to have utilities. So that's another ratio here. Declining, but possibly showing some improvement. Then we look at what are called bellwether areas of the U.S. economy. And these are very important industries here. Semiconductors, they've been declining, possibly improving. Home builders, declining, possibly improving. Transports, declining, maybe improving. Retail, and I have another chart of retail here in just a second, declining, possibly improving because this is a huge part of the U.S. economy. Regional banks, Republic Bank, Silicon Valley Bank, New York Community Bank, we want them to stay afloat. If they fall apart, that's when markets fall apart. Well, this had been declining, but is showing signs of improving. This is retail, and this is a ratio between the retail sector and the S&P, which has been underperforming now really going back to 2022. So that's kind of longer term negative, but things are still holding up okay because we look at the retail sector by itself and it's been in an uptrend. Well, now it's in a downtrend, but we're showing some improvement as the RSI is trying to cross back above 50. So the momentum is showing some improvement there. Then we look at a risk on to risk off ratio. When this is going down, that's risk off. Folks are getting out of the risky stocks and getting into either safer stocks, going to cash, or going to the bond market. Well, this ratio looks at the high beta versus equal weight, which is considered more value oriented here. We've seen some improvements here, although we've really been declining with this ratio. We are showing signs of improving. And that's what you're going to see in a lot of these charts here, even on the negative side. The value to tech ratio, value to growth. And now, as this has been coming down, that means value is underperforming. And we've been chopping around, chopping around. Well, in 2025, value's been outperforming tech, but this is coming back down. So we're seeing of an improvement here, but we need to see this continue to fall down below the rainbow. That would be more positive for the market. If this ratio turns and goes back up, that means the market's getting more defensive again. And then just somebody I read somewhere thinks that we're out of correction territory now. We're not. We're still down over 10% from the February all-time high, according to this chart. A little bit over. I mean, nitpicky, but there's a lot of people that they do different things if we're down 10% versus 9%. So we're down just a little bit more. If we do go up from here and we get under this 10% level, which means this blue line is going to go down, now we're back into just pullback territory. If we really turn and go down and we get up over 20, that's when we're in a bear market. So to be more positive, we want this line to go down. And this is called a bow tie because, the cool little lines here and they're different colors and some are short and long and they kind of form a little bow tie right here. I didn't create this, but this is more of a short-term trend look here where we are improving. We're negative because we want to see this neon green line on top. That's when we're positive. And the dark blue line, we want that to be on bottom, kind of like when we were going up over here. Well, we're improving here and the lines are starting to go back up. So it is improving, but it's still negative overall. The condition of the intermediate term trend, negative, but improving. We have a double and triple exponential moving average based on 50 periods here. We're starting to turn up here a little bit and we're getting above both of the lines. But until these really start to go back up, and if price can stay above these lines, I'm still treating this more as negative until proven otherwise. And we're above the 20 period moving averages, but we have a whole spaghetti mess of other moving averages that we're still below. And any one of these, if we continue to try to go up, any one of these can end up providing overhead resistance. So we want to keep an eye on that one. And this is the intermediate term trend. The short term trend still looks like, tangled all up, like Rapunzel tangled. Well, this is intermediate and it's a little smoother to read this. We're well below these lines and the lines are going down. So that means the intermediate term trend is still negative. And this, I told you earlier, this is the weekly chart of the parabolic SCR. We're positive on the daily side since the dots are underneath. We're negative here on the weekly side since the dots are on top. And we saw a little bit of a move down here. This is Zohorchak. And I always say this, a good old-fashioned American Midwestern family name there. Well, these are very long-term signals. And we've been on a full-on 10, which means a full-blown buy signal. Really going back to most of 2024 and then into 2025. And as we were going down, I kept waiting for this to change. And now that we're going back up, we saw this drop from 10 to 8. Now, that's not a negative signal, but it is going down. When we're more positive, we want this to be at a full-on 10. Now, if we do start to go back down and we eventually drop below 0, then that's when sell signals are starting to be generated. You can see we had some back in 2021 into 2022. So we just want to watch this longer term. Yeah, when we look at the trend of the Dow, we're at a downtrend. The 50 is below the 200, and you're going to see that with all the indexes here. In a downtrend with the Nasdaq, in a downtrend with the Nasdaq 100, but the momentum for the Nasdaq 100 is positive. But I wanted to keep these charts together. In a downtrend for the small cap S&P 600, in a downtrend with the small cap Russell 2000, in a downtrend with the mid caps, in a downtrend with the micro caps, the smaller stocks. We're in a downtrend with the bank ETF, so we want this to be doing a little bit better. And we are showing a little bit of improvement. When we look at the regional banks, these are the smaller banks, and we do a ratio with the financial sector. And this has been really under a lot of pressure, and that's causing some concern. Well, over the last few trading sessions, this has started to bounce back up. We would like to see this ratio go back up to be more positive. Wilshire 5000, a broad market measure underneath with a downtrend. Total US stock ETF, downtrend, still below both moving averages. The FANG index just starting to generate a death cross here. This is Facebook, Apple, Amazon, Netflix, Google, Nvidia, all the big ones that you can think of. And it had held on for a while here, but now it's starting to generate a downtrend. And then we look at some ratios between stocks and bonds. This first one here is the S&P 1500. That's a broad market measure with short-term bonds. You're going to see a lot of the same thing on the charts that I show right after this. Below the rainbow, but improving. Broad market to 3 to 7 year bonds. Below the rainbow, but improving. The tech sector to 3 to 7 year bonds. Below the rainbow, but improving. Riskier bonds to more, that's junk bonds, with more conservative bonds like high grade corporate bonds, government bonds. This is showing some signs of improvement. When folks are willing to get into the junk bonds, they're willing to take on more risk because they get a better yield. Well, when the market's falling apart, they're not as willing to jump into junk bonds because they think that those bonds might turn into junk for some reason. Well, this is improving a little bit after it's been under pressure lately. We're still below this trend line on the weekly chart with the NASDAQ 100 going back to 2009. And here, the Qs to 3 to 7 year bonds, below the rainbow, but improving. And then this is another way of saying, what does the market think if we're going to go into a recession or not? When we're above the rainbow and going up, that's what the market thinks will be a soft landing. They're preferring stocks over bonds. And that means that they think that we will not be going into a recession. Well, everything's kind of changed recently, and we're down in this hard landing area now, meaning that we might go into a recession. But we're improving a little bit with this ratio. So we are below the rainbow and improving. We really want this to go back up if the market thinks that we will not go into a recession. This is an inverse of that same thing. When this is going down, 3 to 7 year bonds are underperforming. Lately, they've been outperforming, but showing some recent weakness. Home construction. And this actually was the first area to start going crazy. And it went crazy back in late 2024. We were doing really well with this above the rainbow. And then all of a sudden, it started to fall apart. Even before the end of 2024, it bounced back a little bit, but it's really been coming down here. This is the ratio between home construction and 3 to 7 year bonds. This is a very interest rate sensitive area of the market, and it didn't like what it was seeing here. And we're trying to improve a little bit, but a lot of damage has been done with this. And this is a long-term oscillator called the special K. We're negative here on the daily chart. We're still barely positive on the weekly chart, which I don't have to show you here. Long-term rainbow still below all the lines, trying to bounce back up here, but we haven't even come back up to the rainbow yet. And then the S&P to utilities ratio, it did bounce back up a little bit, but when this is going down, that means the S&P is underperforming utilities. A mixture of growth versus value, the S&P, and utilities, which are considered to be value. But you could also make a case that utilities are growth because we need all this electricity for AI and electric vehicles and crypto mining and all those things. But still, it's considered to be more defensive. But we want this ratio to go up if we're going to be more positive. And we are improving, but we're still negative when we look at a 5 period moving average of the highs and lows across the Amex, NASDAQ, and NYSE. But hasn't turned positive yet. We are showing some improvement with the 10 period moving average of the highs and lows for the S&P. This is longer term. We want this to get back above 50 to turn positive and to see it continue to go up. As long as it's still below 50, that's negative. And we're improving with the 50 period moving average of the new highs and new lows for the S&P, but we're still below zero. And we're still below all the moving averages here with large cap growth, the ETF. We've been improving, but a lot of damage was done here. We need to get back above these moving averages to turn back more positive. Dow Jones Semiconductor Index, and you look at all the different semi charts that I have, every one of them is in a downtrend. I just decided to show this one. We are improving, but we're in a downtrend and we haven't even come back up to the 50 or let alone the 200-day moving average. And this is going down, but improving lately. When we look at a ratio between semiconductors growth and the Dow, more value, we want this ratio to go up, but we've been seeing this decline now for quite some time. And the dollar's in a downtrend, and we're dropping below 100. It'd be nice if we saw a little bit of strength, which kind of goes against what you would think should be happening. Because right when the dollar really took off, that was around the election. And then Trump won, and he says, tariff, tariff, tariff. And that's why the dollar was getting stronger, because that's a protectionist type of strategy. Well, we're setting all these tariffs in motion now. How come the dollar's going down? That kind of goes against what you would think should be happening. And so there's rumors out there of some kind of manipulation going on because the stock market actually likes a weaker dollar. It does better for the conversion rates and for the import-export relationships. And this is still improving, but negative. And this could be dangerous to the market. This is the SPY, which is the ETF for the S&P, to staples, toilet paper, toothpaste. You notice how this ratio was really going up? That means the S&P was outperforming staples. And then at the end of 2021, it just started to roll over. We hit the all-time high in the S&P in January 2022, so there was a lag there. This was already starting to fall apart. And then we went into 2022, and that was an ugly situation. And then we finally turned back, and we're doing better here. Well, look at what's happening over here. We're seeing a similar type of disintegration here. And if we don't see some real improvement, we're wondering if something similar to the end of 2021 is happening now in 2025. We'll just watch this and see if it continues to develop that way. Then some areas I'm watching, jobless claims. And for right now, the employment area is holding up quite well. The weekly jobless claims are doing okay. They're actually declining. That's strength in the overall job market. Now we're going to get the employment situation report this upcoming Friday, May 2nd, and maybe that will shed some light on things. And we've been just chopping around with the continuing claims. These are a little bit longer term, and we're actually seeing the 4 week moving average declining a little bit here. This puts all of them on the same chart. Red line, that's initial claims. Blue line, that's continuing claims. We'll also get an updated unemployment rate in Friday's report. And another thing that I don't know whether this is positive or negative, so I put it on the watching side. When we were screaming down, volume was just massive. Well, as we've been chopping around, some up days, some down days, we are now below average with volume. So uh, you can make a case either way for that. And we're keeping an eye on the 10-year yield. It looks like interest rates are stabilizing. Where we were really screaming down here, that's when we were seeing this flight to safety. People were getting out of stocks, going into bonds. And then 2 weeks ago, we just saw this massive 0.5% gain in the 10-year yield in 1 week. And that was crazy. Well, we seem to be coming back down and not moving around with as much velocity right now. So that's improving, but it will help if interest rates continue to fall. That helps stocks usually. And we just want to keep an eye on this cash to 3 to 7 year bonds. If this was going up, the market would be concerned about inflation and interest rates. This is going down. So that means on a short term basis, the market's not really concerned about inflation or interest rates. And we're seeing a similar story here when we look at tips, which do adjust for inflation and interest rates. That's what people get into when they think interest rates are going up. And so they outperform. Well, now they're underperforming, even though they did bounce back a little this week. But we're not seeing any massive concern here when we compare tips to 3 to 7 year bonds. And when we look at tips to 7 to 10 year bonds, not really seeing any real concern here either. Now, that could change. That's why we watch these charts. But over the last few weeks, as the stock market's been going crazy, these charts have not really been going crazy. And then the mass index, we are potentially seeing a signal here. If we come down below this red dashed line, that tries to signal a reversal. And we've been going up, so maybe that means we'll reverse and go down. I wouldn't base everything around this chart, but it's just something that we keep an eye on. And at the same time, the Pring bottom fisher, it's generating a buy signal. Well, it did generate a buy signal here at the end of March, and oh boy, that would not have been a good signal because things just fell through the floor here. We'll see if this one ends up being legitimate. Again, this isn't a chart that I use all by itself. I just use it in conjunction with other charts. And we want to keep an eye on the 10 to the 3 month yield curve. It's inverted. Where the 10 to the 2 year, it's fine. It's not inverted right now, but we're just kind of chopping in and out of being inverted with the 10 year to the 3 month. We want to keep an eye on oil, even though it hasn't really been climbing, it's more deflationary. The and I watch this, not only is it going up or down, but geopolitically, this oil can really gyrate all over. Something crazy happens in the Middle East. And we want to keep an eye on the spread between risky and not as risky bonds. This seems to be coming down a little bit, but on the next chart, you see it going up. That's an inverted scale here. So this going up means there's a decrease in fear in the bond market. And I use this more like a sentiment gauge. So this going up as the S&P is going up and the VIX is here, it's inverted, so it's going up. That's more positive. So thank you. I really hope you found this helpful. I hope you're having a wonderful weekend, and I will talk to you in the next video.